Hello and welcome to my channel Fiscal Voyage, and today we're going to talk about AT&T, and we're going to determine in a 5-minute video analysis if AT&T is a buy, hold, or sell coming right now. Alright, so here's the 5-minute stock analysis of AT&T. It could be found in New York Stock Exchange as the letter T. AT&T is an American multinational conglomerate holding company. It is the world's largest telecommunication company, the largest provider of mobile telephone services, and the largest provider of fixed telephone service in the United States. And in June of last year, it also is the parent company of mass media conglomerate Warner Media, making it the world's largest media and entertainment company in terms of revenue. And as of 2018, AT&T is also ranked number 9 on the Fortune 500 rankings of the largest United States corporation by total revenue. Let's look at some fundamentals of the company. From the last 10 years, revenue grew at a compound rate of 3.71%, which is pretty good for this company this size, so huge. And net income grew at a better rate of 4.95% during that same time period. AT&T has a current S&P credit rating of BBBs, and earnings per growth has a 3-year average of 6.34, which means good things because earnings is how they pay out dividends. So earnings have been growing at 6.34%. Revenue 5-year average has been increasing at a 5.81% rate. However, operating income for that 5-year average has decreased 3.02%. Net income over the past 5-year average is at 1.20%. So net income is growing very slow there. Let's look at some more fundamentals. In 2018, adjusted earnings came in at $3.52. Net margin for that year was at 11.34%. Actually, net margin compared to 2017 is compressing. 2017 it came in at 18.34%. This could be of concern. Debt to cap is at 47%. Current dividend yield is an outstanding 6.06. And with that high yield, they actually have a great payout ratio of only 57.95%. So they do have funds to continue paying this high dividend. But there is some drawback, and I'll explain later. Consecutive years of dividend growth came in at 35 years of consecutive growth, which is outstanding. However, the past 5-year average dividend growth rate came in at 2.1%. So they're just beating inflation, or even not beating inflation, how you want to look at it. The Chowder rule came in at 8.16. I like to see companies coming in at 12 or even 10 being conservative. However, this one came in at 8.16. And the most recent dividend increase came in earlier this year at 2%, which falls in line with their 5-year dividend growth rate. For the future, analysts expect this year earnings coming in at $3.57, and in 2020 coming in at $3.67. So earnings will continue to grow, which is good. It's needed to pay dividends, and a growing dividend at that. CFRA has a 3-year projected earnings growth of 1%. Currently, they have a PE of 9.47 with a forward PE of 9.37. And the good news is the average 5-year PE is at 12.64, which means that the stock is undervalued based on the PE ratio. Now let's look at the fast graphs. As you can see, the black line represents the monthly closing price, the blue is the normal PE, and the orange is the earnings PE. As you can see, the black line is under both orange and blue. The normal PE for the 10-year time frame is 13.54, and we see that currently shares PE at 9.49. I like in this graph, I like to make sure that the monthly closing price is lower than the normal PE. Based on this, it looks like the price follows the normal PE. So with that, it looks undervalued based on the fast graph. Let's see how undervalued is it. Right here, CFRA has a fair value of $36. Simply Wally at 66, which is very high in my opinion, but that's what they have it valued at. Fast Grabs, based on the normal PE, has it at $48.33. Yahoo at $33.63, and my dividend discount model analysis came in at $29.73. Averaging out the 5, we get a fair value price of $42.90. Currently, you could get the stock AT&T for $33.71, which means that the stock is undervalued by 27.26%. And that is outstanding. With that, my recommendation is a buy. I currently hold AT&T in my portfolio. It's actually one of my largest investments. I love the yield. The only problem is the dividend growth is only at 2%, so you're barely, if that, beating inflation. This is more toward income-driven investors. I like it to have my portfolio because I find it undervalued currently and of the high dividend yield. Even though the stock is not growing at a high rate, you still get rewarded at 6%, dividend yield, with the possibility of valuation changes. Basically, AT&T price moving up towards its normal PE. Like again, with that, I recommend that as a buy at current prices. Make sure to follow me and subscribe to my channel. Let me know what you think of this recommendation and what you think of AT&T. Do you hold it in your portfolio? And make sure to check out my website, fiscalvoice.com. And thank you for watching. Make sure to subscribe. And thanks again.